Hello and welcome to In Depth. I'm Aditi Nagpal-Girotra. 1st November is observed as the foundation day of the Employees Provident Fund Organisation. The day marks the rollout of the Employees Provident Fund Scheme on 1st November 1952. This was the first social security scheme under the EPF Act. Beginning its journey with a few lakh beneficiaries, the EPFO now services more than 4.5 crore employees who are engaged in around 6 lakh contributing establishments. With over 63 lakh pensioners, the EPFO is the 21st largest pension fund globally. Recently, e-governance initiatives of online coverage of establishments, online grievance redressal, and online filing of claims backed by universal account number have all generated a huge trust in public service delivery. It is noteworthy that more than 50% claims in EPFO are preferred through online mode, indicating a wide acceptance in just 1 year of its rollout. In Depth today takes a look at this unique institution that safeguards the vital life savings of lakhs of people, and how it is one of the most widely used investment schemes by the salaried class. The Employees Provident Fund Organisation provides social security to crores of employees in the country. It was established in 1951 with the aim of providing a kind of financial security to employees in the organized sector. Over the years, EPFO has also projected interest rates, even as banks reduce theirs. In our first report, take a look at the formation of the EPFO and the role it plays in ensuring social and financial security of crores of employees.
Employees Provident Fund Organisation, or EPFO, is one of the world's largest social security organizations in terms of clientele and the volume of financial transactions undertaken. Currently, it maintains over 19.3 crore accounts pertaining to its members. The Employees Provident Fund came into existence with the promulgation of the Employees Provident Funds Ordinance on 15 November 1951 before being replaced by the Employees Provident Funds Act of 1952. The Employees Provident Funds Bill was introduced in Parliament with the aim of providing for the institution of provident funds for employees in factories and other establishments. The Act and the EPFO schemes are administered by a tripartite board known as the Central Board of Trustees. This board consists of representatives of both central and state governments, employers and employees. The Central Board of Trustees administers a contributory provident fund, pension scheme and an insurance scheme for the workforce engaged in the organized sector in India. The board is assisted by EPFO, which has offices in 135 locations across the country. The board operates 3 schemes: EPF Scheme 1952, Pension Scheme 1995 and the Insurance Scheme of 1976.
This is perhaps the world's largest organization, and the purpose of this EPFO is basically the social security of the workforce in the country. And so what happens, in fact, if any worker is there, so normally they are not able to do the savings, personal savings, which is very important for them, in times to come, for the education of their children, after the retirement. So it's very important. So this EPFO provides a social security to the workforce of the country.
EPFO stands for Employee Provident Fund Organisation. Now, to put it in very simple terms, it's perhaps the world's largest social security organization. Any organization which has more than 20 employees contributes to it. Now, what does it get? Basically, it ensures a retirement benefit. It does retirement planning of employees. Now, in simple terms, an employee works till 60, 55, 65. After that, how does he survive? There is where EPFO or EPF steps in.
The EPFO's main aim has been to extend the reach and quality of publicly managed income security programs. It is one of the most widely used investment schemes by the salaried class. At a time when interest rates at banks has fallen rapidly, the Employees Provident Fund provides an interest rate of 8.65% for the year 2018-19. Besides a more or less steady interest rate, there is also the possibility of higher returns on your Provident Fund kitty in the future. That's because EPFO invests 5 to 15% of its investable deposits in exchange-traded funds. Also, 45 to 50% of the PF kitty has to be invested in government securities, 35 to 45% in debt instruments, and 5% each in money market instruments and infrastructure trusts.
So see, the rate of interest in the EPFO saving is the highest rate of interest, and the challenge is that if this EPFO provides the rate of interest of say 8%, earlier what were they doing? This organization was they were depositing or investing their funds into the bank FDR mainly, but the interest rates of the banks are not as much as to give the rate of interest of say 8% or so to the EPFO account holder. So then it was changed. In fact, some money was invested into equity also, because there the return may be higher. So now it works like a mutual fund type of thing. So some part is deposited into the FDR and some part is invested in like mutual funds. So there are 5 companies, big companies, including State Bank of India, who are now managing these funds.
If you talk about banks, now banks, the deposit could be for 3 months, for 6 months, for 1 year, then people may withdraw it after 4 months or 8 months. EPF, it's a longer scheme, though there are premature withdrawal facilities, but basically the investment is for long term. That is one thing which ensures high rate of interest. Secondly, now EPF money is invested quite prudently. Some money goes into ETFs, some into GSECs, some money goes into stocks also. So I think the investments are managed in a decent way, corpus is high, and since the investments are for longer term, that's how they are able to generate higher rates of interest. And then all trade bodies, employee organizations, unions, they also try to ensure that people get good and high rates of interest.
Another benefit is that an employee's contribution towards an EPF account is eligible for tax exemption under Section 80C, even as the interest rate earned is exempt from income tax. In fact, your EPF account continues to earn interest even if it has been lying dormant for more than 3 years. EPF withdrawals are also not taxable after 5 years of continuous service unless the employer terminates his or her business or the employee voluntarily quits his or her job. Bureau Report, Rajya Sabha TV.
Under the government-run Employees Provident Fund Scheme, employees contribute a small portion of their basic pay every month towards the fund. For most salaried individuals, EPF forms the backbone of their saving needs. Currently, investment in EPF fetches interest at the rate of 8.65%. But the government has laid certain conditions under which one can withdraw from his or her Provident Fund account. Here are the details about how you can withdraw funds, whether partial or full, and how to be aware of fraudulent activities.
Employees Provident Fund or EPF is a government-run pension scheme focused on salaried individuals. EPF is a part of one's salary that is deducted each month for retirement saving. This social security fund is governed by the Employees Provident Fund Scheme 1952. Employees Provident Fund Organisation or EPFO, the nodal agency that monitors EPF contributions, allows the subscriber or employees of an organisation of 20 or more individuals to make a partial withdrawal from a PF account under certain conditions. According to the EPFO website, subscribers can put a claim for advance withdrawal online via EPFO's website unified portal mem.epfindia.gov.in. However, for initiating withdrawal from a PF corpus, the subscriber must have an active universal account number. The claim is then forwarded to the employer for approval. Once approved, the amount is credited to the subscriber's account within 10 days. But there are some conditions in which a partial withdrawal is permitted from a provident fund account. According to EPFO, partial withdrawal from EPF accounts is allowed for purchase or construction of house, repayment of loan, non-receipt of wage for 2 months, marriage purpose, for medical treatment of family members, etc. under certain conditions. Apart from this, the retirement fund body also allows a 100% withdrawal in some cases. An EPFO member can withdraw the entire amount of the fund in case the subscriber is unemployed for 2 months. A member who has not attained the age of 55 years at the termination of the service shall withdraw the full amount standing to his or her credit. He or she can withdraw the total amount from the retirement kitty on retirement on account of permanent and total incapacity for work due to bodily or mental infirmity. Besides this, in cases of migration from India for a permanent settlement abroad, the withdrawal is allowed. Withdrawal is also allowed in cases of employment abroad. As the EPFO has started crediting interest to its 6 crore subscribers across India, Provident Fund account holders have also been warned against a fraud. In the past, there have been cases where PF account holders found that somebody had withdrawn money on their behalf several months ago. In a case of fraud last year, a crook posed as an official of the Provident Fund body and sought personal details for processing of Provident Fund withdrawal or updation of KYC status in UAN. Since then, the EPFO has been taking several steps to strengthen its security system.
Sometimes it happens that somebody calls them and they ask them that, sir, we are calling from EPFO and we have to give some additional interest to you, and or they offer something which is not realistic. Then they ask their account detail, their PAN detail, their KYC detail, and with the internet fraud, they withdraw the funds from their account. So these type of funds are basically there. There are many accounts which have a negative balance, and there are a lot of frauds, but frauds are in the category that due to the information which should not be passed on to anybody, that is passed on because of some unrealistic offer. They don't understand sometimes, and sometimes they think that this phone is from the EPFO itself. So my advice will be to all the account holders of this PF, never share your details, your account detail, your KYC detail, any details, because nobody is going to ask these details on phone from any of the account holders.
For this, the EPFO flashes an alert on its website and Twitter handle asking its members not to share their personal details like Aadhaar, PAN card or bank details over the phone. It has also asked subscribers to never share their details or deposit any amount in the bank. It says sharing such details can help a hacker log into your EPF account and compromise its security. EPFO says those who have changed jobs but are yet to transfer their old PF account balance to the new employer are usually the targets of such hacking attempts. Bureau Report, Rajya Sabha TV.
With this, we'll halt in for a quick break, but we'll be back soon. Stay tuned with us.
Watch Policy Watch with me at 10 p.m. only on Rajya Sabha Television.
What are some key legislations introduced in Rajya Sabha? Some of the key legislations introduced in Rajya Sabha are the Indecent Representation of Women Bill 1986, the Indian Succession Bill 1991, and the Marriage Laws Bill 1999.
देखिए विशेष मेरे साथ आज शाम 7:30 बजे सिर्फ राज्यसभा टीवी पर। Bhul Bhulaiya, a labyrinth of hundreds of narrow stairway passages, is a significant and historical component of what you popularly know as Bara Imambara. Some of these narrow stairways have dead ends, some end at precipitous drops, while others lead to entrance or exit points. Historically, Bhul Bhulaiya was constructed to confuse the enemy intruder, and the narrow lanes of the labyrinth can make anyone feel lost. The structure contains various strategically built hollows in the corridors.
Welcome back. You're still with us on In Depth. An EPF account holder can avail multiple online services on its website. It also has different schemes that employees can avail of. Let's take a look at them.
The Employees Provident Fund Organisation aims to extend the reach of publicly managed old age income security programs. And since it is the repository of hard-earned savings, it places a high value on transparency, honesty and integrity. The EPFO offers 3 schemes to its subscribers. The EPF Scheme 1952 allows payment of accumulated savings plus interest upon retirement and death. Partial withdrawals are allowed for education, marriage, illness and house construction. It also consists of housing scheme for EPFO members to achieve Prime Minister Modi's vision of housing to all Indians by 2022. The second is the Pension Scheme 1995 that has monthly benefits for survivors, widows or widowers and children or upon disability, superannuation or retirement. It also carries a maximum pension on disablement besides past service benefit to participants of erstwhile Family Pension Scheme 1971. Then there is the Insurance Scheme 1976 in which benefit is provided in case of death of an employee who was a member of the scheme at the time of death. The benefit amount is 20 times of the wages with a maximum benefit of 6 lakh rupees.
Most of the people who are employed, who are working in an organization which employs more than 20 or beyond the threshold limit. Now what happens is the entire information would be given to EPFO. So in turn we can come to know how many people are working, because if the subscribers of EPFO increase, it's a simple indicator that more people have got jobs. If somehow EPFO subscriber base decreases or there is not much increment, we'll come to know that there's a lesser quantity of people who have got jobs. Now in case all of a sudden we get to know that there's a huge increment in the subscriber base, what does it mean? There are lots and lots of jobs. If the subscriber base has increased only by a small quantum, then it tells us that not many people have got jobs, particularly in the organized sector.
Over the last few years, the EPFO data has also become useful as an indicator of net employment generation in the formal sector. This is given by the net additions to the annual EPFO payroll data.
There are 2 types of organization in our country. One is organized sector, one in unorganized sector. What happens in fact that there is a large unorganized sector also, where the workmen are not registered under this Provident Fund scheme. So what happens? When they shift from unorganized sector to organized sector, they are covered into this Provident Fund scheme. That is very good in fact. So because if they will be shifted to organized sector, ultimately as I told you that their social security will be there, and then definitely if the data of EPFO is increasing, meaning thereby that more and more people are getting jobs in the organized sector.
EPF contributors are also identified by UAN or Universal Account Number. It is a 12-digit number that is allotted to an employee who is contributing to the EPF. The UAN acts as an umbrella for the multiple member IDs allotted to an individual by different establishments. It remains the same through the lifetime of an employee and does not change with a change in jobs. Linking multiple member identification numbers to a single universal account number helps members to view details of all the member identification numbers linked to it. The UAN also helps in easy transfer and withdrawals of claims. Bureau Report, Rajya Sabha TV.
The question of investing EPFO money in stock markets has been the topic of much debate. The matter even came up in Parliament 3 years ago when the government made its stand clear on the matter.
The question of investing EPFO money in the stock markets has been the subject of much debate. The issue came up in Parliament as well. Rajya Sabha had one such debate in August 2016 over a motion on the alleged diversion of money from Employees Provident Fund to stock market. The government categorically told the House that workers' money has not been diverted to, but is invested in funds which are safe and profitable. The NDA government said investments had been made in exchange-traded funds, ETFs, and not in share markets. ETF is a fund that holds several assets like stocks, commodities, or bonds. Further, most ETFs track an index like a stock index or a bond index. Then Labour and Employment Minister Bandaru Dattatreya said the funds are generally for 10 years or more period. On the quantum of investments in ETFs, the minister said that the Finance Ministry had prescribed a minimum 5% of investable deposits and maximum 15% in ETFs.
One thing which is going to be very good is if in future, because there is a possibility that in future what may perhaps happen is that the subscribers may perhaps get an option to increase or decrease the stock market component of their investments. Now, if that happens, that would be a unique thing because here the investments are for longer term. We all know in the longer term, equities offer higher return generally in comparison with debt or any other asset class. So, if going ahead, this facility is there that one may increase or decrease his equity component, that would be, I think, a very new, good, innovative feature.
Of the total amount, 75% is investment in Nifty and the remaining 25% in BSE. The minister said the funds are not invested in individual shares.
Nifty 75% and Sensex 25% because it is in the baskets. It is in the basket.
Various political parties and trade unions have argued that investing in stock market is risky. Another concern has been that of private companies not depositing their PF contribution. Bureau Report, Rajya Sabha TV.
So that's it from us today in In-Depth. We'll be back same time tomorrow with the focus on some other subject. In case you miss a television broadcast, you can also watch our program online on YouTube, the link for which is given below. Suggestions and feedback about the program are also welcome. Thank you for your time.